Daniel.
And I'm Mira.
And before we really get into the weeds today, just a quick reminder for you all. Everything we unpack in this deep dive is strictly for market context and, intellectual discussion.
Right, exactly. We're just here to analyze the tape. It's definitely not personal investment advice or a recommendation to buy or sell anything.
Yeah, we just want to help you understand the baseline narratives the market is actually operating against today.
And honestly, the narrative today is just wild. I mean, imagine waking up, pouring your morning coffee, and checking the news, only to find out that roughly 90 missiles just flew over the most vital oil choke point on the planet.
You would completely panic. I mean, I would panic.
Right. You'd assume oil prices were about to absolutely explode, inflation would spike, and, the markets would just be a sea of red.
But that is the exact opposite of what happened today. Oil prices actually plummeted, and the tech sector just partied like it was a bull market peak.
It really is one of the most fascinating divergences we've seen in a long time. You have this incredibly acute geopolitical tension on one side of your screen, and on the other, investors are just bidding up tech hardware like there's absolutely nothing to worry about.
Yeah, so we are going to unpack all of that for you today. We'll break down exactly how the market is rationalizing these missile strikes, and then we'll look at how the AI capital expenditure cycle is essentially hitting warp speed.
Yeah, we're talking hundreds of billions in new investments.
Exactly. And finally, we'll open up the books for a live look at our paper trading portfolio to see how we're positioning for all of this.
Sounds good.
All right, so let's get right into session one. What set the stage before the U.S. session opened?
Well, to really get it, we have to look at the prior session's carryover. The backdrop overnight was highly kinetic. We had President Trump effectively declaring that the fragile mid-June Hormuz ceasefire was just over.
Right, he cited those Iranian attacks on commercial shipping.
Exactly. And then the escalation actually happened. The U.S. military struck roughly 90 Iranian military targets. We're talking air defenses, coastal surveillance, drone launch sites.
Wow, 90 targets.
Yeah. And in retaliation, Iran fired ballistic missiles and drones at U.S. bases in Kuwait, Bahrain, and Jordan. The sirens were sounding around 11:06 a.m. local time, which was 4:06 a.m. Eastern time.
Okay, and this is where I just have to stop and say this makes zero sense to me. The Strait of Hormuz handles what, like a fifth of global petroleum liquids consumption?
Basically, yeah. And it's a massive artery for the world's liquefied natural gas trade, too. If that closes, the global energy supply is fundamentally crippled.
Right. So looking at this through a game theoretic lens, why isn't the market treating this geopolitical event like an unpredictable natural disaster? Like an earthquake hits, supply is threatened, prices spike.
You'd think so, but no.
Yeah, West Texas Intermediate crude actually plunged 4.7% intraday. It hit a low of $71.42 a barrel. How does oil drop when ballistic missiles are flying over the most important energy corridor on Earth?
I know, it sounds completely counterintuitive until you look at the exact mechanism the market is using to price this risk. The market is actively fading the risk premium right now.
Fading it? How?
Well, yes, both sides are exchanging these very heavy, calculated blows, but traders are essentially calling their bluff on a total permanent blockade.
Calling their bluff on a multi-trillion-dollar game of chicken? That seems insanely risky.
It is, but think about the incentives, right? The market views these types of energy shocks as mechanical taxes on the global consumer. If the strait closes permanently, literally everyone loses.
Right, including Iran, because they rely on selling their own oil.
Precisely. So the tape suggests traders see a path toward de-escalation. They're viewing these strikes not as the start of World War III, but more as a violent tit-for-tat reestablishment of deterrence.
I see. So by dropping the price of oil, the market's basically saying, we've seen this movie before, you've made your point, but the oil will keep flowing because nobody can afford for it to stop.
Exactly. They are treating it like a very dangerous but ultimately solved equation.
Got it. And just to quickly compress the rest of the global macro picture before the New York Open, there were two secondary drivers overnight, right?
Yeah, the European Central Bank released their June meeting accounts. They were warning about sticky headline inflation and noting that tight credit is dampening their economic growth.
And then U.S. Trade Representative Greer also noted that China is actively buying U.S. soybeans, which kind of cooled some trade war anxieties.
Right, but it's worth noting those are mostly relevant if you follow the industrials or agriculture sectors. They weren't really the main engine driving the broader U.S. market narrative today.
Yeah, the real story was that because the market realized oil wasn't going to spike and trigger a massive inflation wave, it suddenly had the breathing room to look at the domestic U.S. economy.
Which was a huge relief for equities.
Definitely. So to wrap up session one, fading energy fears set a surprisingly bullish tone for U.S. equities today. We're going to take a really short break, and when we come back, we'll explore how this translated into a massive tech rally once New York opened.
Welcome back. Let's dive straight into session two. What actually moved markets during U.S. trading hours?
Well, it started right away with the labor market. Because, like we said, the lack of an oil spike gave everyone permission to look at the fundamentals again. So at 8:30 a.m. Eastern Time, we got the initial jobless claims report.
And what were the numbers there?
Initial claims actually fell by 2,000 to 215,000.
Which is a really big deal for the tape. You have to put that number into the context of the prior session's anxiety.
Oh, right, the June payrolls print.
Exactly. The June payrolls print earlier was incredibly weak, only 57,000 jobs added. When that happened, the market started whispering about a hard landing, fearing the economy was just stalling out entirely.
So when this new jobless claims data came in steady, showing claims actually fell slightly, it was just a massive sigh of relief.
Yeah, because it shows businesses might not be hiring like crazy, but they aren't aggressively firing people either. It reassured investors that the labor market is just cooling gently.
It keeps that whole soft landing narrative alive.
Precisely. And speaking of keeping things balanced, at 9 a.m. Eastern Time, New York Fed President John Williams gave a speech that gave us a lot to chew on regarding inflation.
Yeah, he really didn't mince words. He noted that inflation is still, quote, far too high.
Right.
But what caught my attention was that he specifically cited the massive wave of artificial intelligence investment as a near-term driver of inflation.
Yeah, which makes sense.
But then he pivoted. He stated that in the long run, AI is actually a positive supply shock that will boost productivity.
And that is the absolute core of the AI narrative right now. It's this duality. In the short term, tech giants are pouring billions upon billions into physical infrastructure.
Buying land, copper, steel, power.
Exactly, to build all these data centers. And all of that physical demand drives up prices. It's inherently inflationary right now. But Williams is validating the long-term thesis.
Which is that once the physical infrastructure is built, the software allows companies to do 10 times the work with the same headcount.
Right, and that massive boost in efficiency is inherently disinflationary in the long run.
Okay, I have to play devil's advocate here for the listener who might be scratching their head.
Go for it.
Is Williams's explanation just a little too neat? I mean, is the market really perfectly pricing in this distant productivity utopia while just blindly ignoring the immediate tangible inflation costs of building all these data centers today?
That tension you're feeling is very real. It's exactly why the tech sector's capital expenditure cycle is under such intense scrutiny. But you really have to look at the bond market's reaction today to see who is winning that argument.
Because the bond market is usually the adult in the room, right? They worry the most about inflation.
Exactly. And today, the bond market took a lot of comfort in Williams' balanced view. The 10-year Treasury yield actually eased back from 4.569% down to 4.539%.
That's a solid move. And that easing was further aided by a very solid 30-year bond auction right in the middle of the day at 12:45 p.m. Eastern Time, right?
Yeah, it was a $22 billion auction, and it cleared at 5.058% with a strong bid-to-cover ratio of 2.44. Wow, okay.
In plain English, that tells you institutional demand for long-duration government debt is incredibly robust. Investors are locking in those yields because they aren't terrified of runaway inflation down the line.
Which ties directly back to something we talk about a lot, the discount rate as valuation gravity.
Right. As yields ease, growth stocks basically get permission to fly. The gravity pulling down their future valuations gets a little lighter.
And fly they did. The NASDAQ was just relentless all afternoon, surging nearly 600 points off its overnight lows.
It was wild to watch.
But before we get to the specific companies that drove that, the Fed actually had one more trick up its sleeve today. At 3 p.m. Eastern Time, they announced the creation of 5 new independent monetary policy task forces.
Yeah, and they brought in some absolute heavyweights to lead them, right?
They did. Former Bank of England Governor Mervyn King and venture capitalist Mark Andreessen are among them.
That is such a fascinating move by the Fed. You don't usually see central bankers teaming up with Silicon Valley venture capitalists. Not at all. It signals a deep structural rethink of their policy modeling. By bringing in external perspectives from the tech world, they're actively trying to map real-time structural shifts in the economy.
Right. They're trying to understand this AI productivity boom rather than just relying on legacy economic models that might be totally outdated.
Exactly. So to wrap up session 2, stable jobs data, a calm bond market, and a Fed that's openly optimistic provided the perfect runway for a massive afternoon tech squeeze. We'll take a quick break here, and then we'll dive right into the corporate specifics that fueled this rally.
All right, welcome back. Let's jump into session 3. What is our corporate events recap, and what should you watch next?
Well, the abstract macro data only takes you so far. The real story today was the unbelievable corporate announcements. If there's one theme you need to understand today, it's the hardware supercycle.
Oh, absolutely. The thesis of AI CapEx, what we call bits colliding with atoms, is just playing out in real time right in front of us.
Yeah, look at the semiconductor space. At 8:15 a.m. Eastern Time, Micron Technology announced a staggering expansion of their U.S. manufacturing footprint. They're committing over $250 billion through 2035.
$250 billion.
I mean, help me understand how a single company even spends $250 billion. What does that actually look like on the ground?
It looks like pouring millions of tons of concrete, honestly. It's building massive clean rooms that are thousands of times cleaner than a hospital operating room.
Wow.
It's buying those extreme ultraviolet lithography machines that cost hundreds of millions of dollars apiece, and securing decades-long supply chains for high bandwidth memory.
Which is crucial for AI chips, right?
Exactly, and they are moving incredibly fast. They expect the first wafer output from their inaugural fab in Idaho by mid-2027.
Yeah.
This isn't just, writing software code. This is heavy physical industry.
You would think the market might be getting exhausted by these massive funding requirements, but the late-day news proved the exact opposite.
Yeah, the SK Hynix news was massive.
All right, SK Hynix, the South Korean memory giant, saw a jaw-dropping $200 billion in institutional demand for their U.S. ADR listing, and they are intending to price at $149 per ADR.
Which just completely shatters any immediate fears of an AI funding slowdown. When you see $200 billion in institutional demand materializing out of thin air for a memory chip maker,
It's crazy.
it tells you global capital is absolutely desperate for hardware exposure. The market isn't questioning the spending cycle at all. They are clamoring for a piece of it.
Okay, so that's the hardware layer. But what about the software side? Because eventually, these companies have to generate actual revenue to pay for all these $250 billion factories, right?
Right, and we got a major tangible update there as well. At 10:12 a.m. Eastern Time, OpenAI CPO Sam Altman gave a highly publicized interview.
Hey, the Commerce Department news.
Exactly. He announced that the Commerce Department officially approved the wide public release of their new GPT 5.6 models. That's the Sol, Terra, and Luna models.
So they cleared a major regulatory hurdle.
They did. Altman noted that they've established a much smoother regulatory relationship with the government, but the real kicker for Wall Street was the performance metric he dropped.
What was it?
He revealed that the new 5.6 model is 54% more token efficient on agentic coding.
Okay, break that down for me. What exactly is agentic coding, and why does a 54% efficiency bump matter so much to the market?
So agentic coding is when an AI doesn't just act like a glorified autocomplete for a human programmer, but acts as an independent agent.
Like it does the work itself.
Right. You give it a complex problem, and it writes the code, tests it, debugs it, and iterates all on its own. Now, to do that, the AI uses tokens, which you can think of as syllables of a word.
Okay.
It takes massive computing power to process those tokens. If the new model is 54% more token efficient, it means it requires less than half the computing power to generate the same incredible output.
Wow. So the unit economics for enterprise adoption just fundamentally shifted overnight. It just got dramatically cheaper for a Fortune 500 company to deploy thousands of these AI agents.
Exactly. It proves that the software layer is advancing just as rapidly as the hardware layer is being built.
Which leads us perfectly into the absolute euphoria on the trading floor today. I mean, think about the news flow we just walked through. Micron dropping $250 billion, SK Hynix pulling in $200 billion in demand, and OpenAI making autonomous coding 54% more efficient.
Yeah, tech investors are basically dancing on their desks today.
Right. The market has apparently decided that if AI is going to write all our code with half the compute, none of us will need to commute to work anyway. So ring that closing bell and enjoy your green screens. Just try not to think about whether those ultra-efficient AI coding agents are currently plotting to optimize us out of our weekend plans.
I think there are definitely a lot of software engineers nervously laughing at their screens today.
For sure. All right, before we move to our portfolio, let's look ahead. What should you be watching over the next 24 hours?
So we have 3 key events on the radar for you. First, on Thursday at 5:30 p.m. Eastern Time, Dallas Fed President Lori Logan is speaking.
Watch for any hawkish tones on inflation there, especially given the comments we heard today about AI investment costs.
Exactly. Second, on Thursday at 9 p.m. Eastern Time, we get the weekly Fed balance sheet update, which is always important for tracking liquidity in the system.
And finally,
on Friday morning, we get the USDA, WASDE, and NOPA crush reports.
and for anyone not trading soybeans, why do we care about agricultural reports?
Because they are critical barometers for global commodity supply and demand. They give you a real-time look at food inflation, which feeds directly into the broader consumer inflation sentiment that the Fed is watching so closely.
All right, that covers the news and the narrative.